welcome you tonight. Thanks for coming. And we should be able to get through this topic pretty quick. Usually about 15-20 minutes is the designated time of the podcast. So give us some feedback. Let us know what you think about the different topics, and if you have any topic or show ideas you'd like us to discuss, to learn further, just email us or phone us or communicate with us. I'm at Rob Lindsay at MLIGA, Make Liability Insurance Great Again. There are two types of policies. There's a claims made and an occurrence form. And in the industry, a claims made policy, the claim needs to be made within the policy coverage period. So if it's a year policy, it needs to be made within that policy effective date and expiration date term of the policy. So let's just use, for example, January 1st of 2025 to January 1st of 2026. During a claims made form, that claim must be made during that policy period. It must also have occurred during that policy period. On an occurrence form, the policy work or services or coverage is applicable during that policy term. It begins on January 1st, 2025. It would not go before that on an occurrence form. You'd have to buy retro to get before that. An occurrence form starts on the effective date and ends on the expiration date of January 1st, 2026. And to get coverage to cover beyond that, an occurrence form has what's called an extended reporting period. And that'll usually is, on most policies, an average of 3 years. Some have no limit to them. Under tort liability, you have a specific amount of time to file a claim in a particular state. The statute of limitations for injury claims is 2 to 3 years, or 2 to 3 years on property damage claims. The average is 3 years. So you can take a look at it. Injury is the first column and the property damage is the second column. 3 years is what they average. So the most time in most states that people have to even file a claim against you is for injury claims is 2 to 3 years, or 2 to 3 years on property damage claims. It does allow you to report claims for up to 3 years after the expiration date. So if you have a policy that begins on 1/1 of 2025 and goes till 1/1 of 2026, it's going to cover for up to 3 years after that to report any claims that are going to be presented against you. January 1st of 2026 is the expiration date. You then would have 3 years, 27, 28, and 29, to report any claims that were not reported during the policy period or during the 3 years after the expiration date of the policy. Again, some occurrence policies don't have a limitation. Most surplus lines, or what we call E&S market policies, have some kind of a tail. It's usually 3 years. Some can even have a shorter tail, like a year or 2 years, sometimes 3 years, or they could have longer than that. You have to read your policy. Even if you have a policy that covers it for 10 years, there's still a statute of limitations. In Montrose, in California, for instance, they were allowed to go back 10 years on property damage claims. So it's not always permanently set in stone, but normally you don't have an ability to file a claim beyond the tort statute of limitations. It's important to consider that even if you buy a policy and you buy this extended reporting period, that there's a statute of limitations. Statute of limitations is the time you must file within to file a claim for either injuries or property damage in a state. For certain kinds of industries or businesses, they can have a long-term exposure. So, for instance, in termite work, that I insure termite operators, termite treatment companies, and inspection companies. they can be held liable for years after the damage has manifested itself. So if you do a termite job or termite application, an occurrence form will allow you 3 years after the treatment date or that policy's expiration date. Sometimes it takes a couple years for the termite damage to manifest itself after they did a treatment, and they insured to be blamed for improper treatment measures, and therefore, you know, a lawsuit doesn't come or show up until a few years, in some cases to 3 years after. So in some states they allow you 6 and 10 years. A few states have 10 years that, you know, they'll allow you to file a claim against someone. That means you have to collect enough money and premium and maintain your records long enough to be able to defend yourself. So you need to pay attention to the statute of limitations. We have what's, you know, called an incident accident reporting form. And should you believe there's some potential for liability, you can report those things on a incident accident form. Like with water parks, we have over 5,000 incidences a year. And because those incidences are reported, and we have a tent recording the taking pictures, getting the witness statements from the personnel that were on at that particular pool and around the lifeguards or the attendants of those pools and the facilities. We take immediate witness statements from everybody there. We parents or friends or family that might be there, and get statements from everybody, and we take pictures, and we have statements from the nurse or attending physician that's on staff there that's going to review at the accident injury tent, and they give a summary on all this is accumulated at once. You have pictures, you have witness statements, you have everything accumulated, and then it's put in a folder, in an incident accident form folder. And that is what we would then use at a later date should somebody present a claim a year down the road for injuries or 2 years down the road. So in some businesses it can be valuable to report things as they happen. So if you have an incident on the job site, even with termite damage, or with other types of businesses, and you have an incident happen and you think, oh, that person's not going to sue me, you just put it on file with us, and then it's covered for beyond the statute of limitations. They have a statute they have to file a claim within, but even if they come after that, we would still honor the claim because it was reported to us. So that's all our policy requires you to do, is to report the incident or accident so we can document everything, put it on file, and be prepared to defend you. So most insurance companies don't have that or practice that, and that's why they're not prepared when people get sued, is because they don't encourage the insurers to collect that information at the time it's most valuable, to get the witness statements, to get pictures, to have documentation at that moment in time is impenetrable, no broader than the scope you purchased for that existing policy, or coverage broader than what you've purchased for that current policy. So just keep that in mind. It enables the insurance company to have everything they need to defend you correctly and the most vigorous defense in a court of law. If you don't have that, then it's normally just you have to settle on some basis if you can't prove all those facts. So it makes a difference of success or failure in the insurance industry. That's why we promote and ask our insureds to pay so close attention that they make an effort to report any incident or accident that may potentially arise above their self-insured retention or is a significant value above the SIR, or what we call a self-insured retention, or what's known as a deductible. Service contractors have what's called an operations liability policy, where termite has a longer term exposure. A tree service company, for instance, they know immediately when they've damaged someone's car, someone's home, an injury to a person. It happened while they were working. It's not something that they caused or that happened or occurred after they left the job site. So they signed an agreement or their invoice and work order which says exactly what they're going to do. Just like on Judge Judy, she says, what did you agree to for the price you charged? It's got to be clearly disclosed to avoid liability for unnecessary types of accidents or injuries that people could blame on you at a later date. But typically with a service contractor, the injuries have to occur while you're there providing the work. We're not guaranteeing a tree, for instance, that after the work is done, it's going to sustain a 50-mile-an-hour wind or not have any complications that, unless it's a limb they left hanging in the tree, which then caused some injury or damage to somebody, that could be potentially foreseen, but or their responsibility, and they would be responsible for any damages or injuries that occur from that. But I always ask my insurers to take before and after pictures so they can prove that the limb was there when they left, if that's in fact what happened. It wasn't broken during a windstorm or another limb, or some kid with a kite flew a kite into it and yanked it down or broke it loose. We want to just affirm and confirm that our insureds aren't the liable parties while other people are living their lives and claim or blame the insured for things that were not their responsibility. So it is important to be able to document, again, prove your case, prove and defend yourself in every situation. But typically claims occur on a service contractor. They're usually immediate when their operations are being provided, meaning you cut a limb, rope fails, it lands on a car, it lands on a home, it injures a person. That's operations liability. It happens normally at that moment. It's not something that occurs later on down the road, like the example with termite treatments. The treatment is performed, and then if they missed a void or someone disturbs that barrier, then a year later that barrier can be penetrated by the termites, and the termites can cause the damage, which then manifests itself to the client, and then they file a claim against the insured. So in that example, there can be a longer term exposure for certain types of businesses or services that you provide, and you need to identify what it is that your greatest exposure is and make sure that you try and accomplish getting those things covered the best way possible and the most affordable. Sometimes, for instance, if you had to buy an occurrence form to give you that extended coverage, you might have to raise your rates to your clients by 40% to cover that offsetting cost you're going to burden and the number of years you may have to pay for that particular coverage. Or, for example, if you buy the retro coverage, you may have to increase your price by 40% to provide the prior year coverage for the policy that you purchased before that may put you at risk and cause you some, risk based on the type of policy you had, based on the type of claims that are potential within your particular business and the clientele you're working with, and the agreements or contracts you used or signed, whether you took pictures at that point in time. Those are all going to be factors as to why you need to consider additional coverage, whether you need to consider you have the additional risks or exposures, and how you're going to actually manage that to control future costs, claims, and be able to defend yourself and have the insurance company provide a legal defense for you as well. And there are important things to consider when you're discussing or considering claims and claims made versus occurrence. So those are things you want to pay attention to. It's important to know because it can mean 40% more, can be quite a bit each year for your policy. And unless you have the right exposures, you probably don't need to spend that money, as well as you can pay attention to the statute of limitations in your state. For instance, if you only have a year or 2 years, then it's probably not advantageous to worry about people suing you beyond the 2-year period or year period, which a claims made policy, if you report it properly and actively, and you put that on your paperwork where you require your insureds to notify you within 30, 60, or 90 days, then in most cases you're able to not need an additional coverage form or the occurrence form to provide for a longer tail. Claims made is more than enough time to report the claim within the policy period, other than services being rendered at the end of the policy period. So those need to be probably watched closer and make sure that you just have an ability to report things immediately, and if anything does go wrong, report it to the insurance company and put it on file, and they can't deny it when you do carry a claims made policy. So again, the claims made is pretty simple. That's why they call it a claims made. The claim must be made during the policy period. Services are also required to be rendered or offered or provided during that particular policy period as well. They don't cover 5 years ago, or they don't cover last year. Covers from January 1st, 2025 to January 1st, 2026, and the services must be provided during that period of time, and the claim must be filed and made against you during that period of time. An occurrence form is the same policy period, January 1st, 2025 to January 1st, 2026, and the claim must be, the services must have been provided during that policy period, and the claim must also be filed within that policy period or for up to 3 years after the expiration date. So you do need to read your policies. You do need to be aware of just the minor things of the indifferences of some policies, because there is some different language. So just pay attention to what you're purchasing. Ask the provider. Pay attention to the statute of limitations in your state. That's usually pretty consistent. There have been changes to those, so you need to at least check on it once in a while. But those are the things you need to be aware of so that you can make sure it's a value to you. And you're welcome to write me an email about any questions you have about these types of forms. An occurrence form, again, and the claims made form have a specific cost associated with them. Usually they're 40% more for an occurrence form, which is 40% more to 60% more. Sometimes if you want a longer tail period, it could even be more additional funds. So you need to consider what kind of financial considerations to make for those particular costs associated with an occurrence form. Our occurrence form is approximately 40% more for the additional coverage for the 3-year tail. Most of the time, our insureds ask for an occurrence form because they have a contract which is requiring it. They're doing work for either a property manager, a property owner, or a commercial business, which is giving them, usually hands them construction risk insurance, which says they want products completed operations, they want an occurrence form, they want personal injury, they want damage to rented premises, fire damage to a rented premise, like if you rented a storage room. It has no bearing on most businesses. Medical expense as well. Medical expense is nuisance medical, which provides slip and fall coverage at your location. Most of my insureds provide services at their clients' locations, and those coverages are non-applicable, because they only apply if you have a specific parking lot or a business that your clients would come to your location and slip and fall at the insured's address. So those aren't even applicable, and they hand them out all the time as relative insurance requirements because they don't understand insurance. Most people that are vendors that request certificates of insurance and request insurance coverage from insureds. And that's what you'd need to consider. Thank you for going over this particular topic. Now you can purchase a retro coverage. A lot of insurance companies will offer a retro coverage for usually 40% more, usually 25 to 45 to sometimes even 60%, depending on what kind of industry you're in. We offer it for up to 40% more, and retro coverage can go back for a consideration for a prior claim before January 1st of 2025 to go all the way for 1 year to January 1st of 2024. So you can buy retro coverage, throw back to a specific date in time. For this example, it's January 1st of 2024. Consider it for payment under the terms of the new contract you have in place, the new policy that was purchased from effective date January 1st of 2025 to January 1st of 2026. The retro coverage will go back for January 1st of 2024. If you have any specific questions that might be able to assist you or help you, we'll be more than happy to help you in any way we can. Thanks for your time, and good luck out there, and we'll talk to you next time. Thanks for joining our podcast. Take care. Bye-bye.